This is the Money Hour with your host, Tina Mitchell, on Alternative Talk, AM 1150. Now, back to the show with local mortgage and finance expert, Tina Mitchell.
Welcome back to the Money Hour with your host and mortgage expert, Tina Mitchell, right here on 1150 AM KKNW, the Saturday 26 show. I'm empowering our community, providing you with opportunities and solutions when it comes to your money. If you're hearing my show at a different time or day, you are listening to a rebroadcast, but you can always call the show at 1-855-400-1150. Again, that's 1-855-400-1150 or online at themoneyhour.com. And in studio right now, very excited to have a conversation with Mathew Gardner, Chief Economist with Windermere Services. And we're going to talk about the real estate market for 2016. Mathew, I am so excited to have you across the desk from me and in studio and the conversation that we're going to have. So thank you so much.
Oh, you're more than welcome. Delighted to be here.
Thank you. And a little bit about Mathew. As Chief Economist for Windermere Services Company, Mathew is responsible for analyzing and interpreting economic data and its impact on the real estate market on both a local and a national level. He has over 25 years of professional experience both in the U.S. and the U.K. Mathew chairs the Board of Trustees at Washington Center for Real Estate Research at the University of Washington, sits on the Urban Land Institute's Technical Assistance Panel, is an advisory board member for the Runstad Center for Real Estate Studies at the University of Washington, where he also lectures in real estate forecasting. So Mathew, let's go ahead and just get started and get right to no market works totally independently. What should we expect from the U.S. housing market in 2016? Drum roll.
That's a great question. I think next year it's going to be a modestly improving year. And when I say improving, I think we'll actually see more transactions. One thing that's been missing a lot in this recovery, actually total number of sales. So I think we will see a slight increase. It won't be the amount that we need, but it will go up a little bit. In terms of prices, I mean, we're going to appreciate next year. We'll likely not appreciate at the same rate we saw this year. Okay. I'm okay with that.
Yes.
I think we're probably
Things have got to balance out, right?
Exactly. Mm-hmm. So I think we're probably going to come in across the country at price growth of about 4.7, 4.8%. Okay. So less than we saw this year, but still, it's a positive. Looking out on the horizon, really, quite frankly, nothing is scaring me. The biggest issue we have right now is inventory and the lack thereof.
Yes.
Far more buyers than we have sellers. It's not just in Seattle. It's not just up and down the West Coast. It's really across the country.
So what do you, how do you think that's going to, you're going to see that improve, or are we for 2016, Mathew? Do you see our inventory getting any better for our buyers?
Yeah, and I think it will.
Okay.
For a couple of reasons. Firstly, we're seeing an increased amount of equity that people are now recovering, getting back the equity that they lost.
Okay.
A lot of things that what's holding people off from selling is the fact that they need to build up that equity or at least recover it, the amount that they lost back in the recession, get above water, and then I think they have the ability to sell. So I think we'll continue to see that. In addition, we're also going to see some downsizing. Mm-hmm. A lot of us are out there who are getting older. We're looking to downsize. I think that is going to have an effect on the market as well.
Exciting.
But we kind of are stuck in a bit of a chicken and egg situation. Mm-hmm. What I mean by that is that we've got people that want to sell, but they're not going to list their homes for sale until they find somewhere they want to buy.
Yes, and when they're concerned about,
if they can't find somewhere they want to buy, they're not going to list.
Yes.
So you kind of get in this chicken and egg. But I think we'll see some improvement. I think sales will probably run up a little bit to probably just over 5.5 million units. In existing home sales next year. I think new construction is going to be the big story, though.
Okay.
We're going to start building, which is something we have not seen.
Yes.
So I expect to see new home starts and sales really jump quite dramatically. That's going to help with some of the pent-up demand there is out there.
Exciting. So interest rates are on the rise, as everybody knows. Are you worried about this, Mathew?
I'm really not.
Okay.
I think it's so much right now, it's a non-story. I spent a lot of time the last couple of weeks, obviously because of the Fed announcement that the Fed funds rate was going up.
You've probably been really busy getting around and sharing the news.
And really, the biggest problem is that everyone thought that the two things, the Fed funds rate was intrinsically linked to mortgage rates.
Yes.
It's not.
Where we saw mortgage rates go down.
Absolutely right.
Yes.
And so I think that a lot of people did get worried in kind of chicken little mentality. Certainly it's important. It's an important rate to watch. And actually it demonstrates an economy that is improving.
Yes.
And so that's actually a good thing. You have to lift interest rates above zero, certainly in the Fed funds rate. So that's going to go up. We will see a modest uptick in mortgage rates. I'm expecting probably a 50 to 60 basis point, i.e. roughly 0.5% up by the end of next year on the 30-year fixed. So that 30-year fix is still going to end the year well below 5%.
Yeah.
So I think the biggest concern that I have is a psychological barrier.
Yes.
And what I mean by that is that people have for the last year or so been quite happy with mortgage rates that started with a 3. And now they're saying, well, what do you mean we've got to pay more than 4%?
Yes, I know, isn't that crazy?
It's egregious.
Exactly.
And you have to stand back a little bit and look at where were they in 1990?
Yes.
Well, they were at 10%.
Yep.
And we still bought houses. Where were they in 1982?
Yes.
For those of you that remember, they were 20%.
Yeah.
And we still bought houses.
Yep.
So I think it really
and the highest they've been when I was in the industry was 8.5 back in 2001, I think is when, so right. It's crazy.
But quite frankly, I think what we're going to see is rates are going to trend up over the next couple of years, but I think they're going to plateau at around 6.5%. I just don't see them with the knowledge I have right now, with the way that it's tied to the 10-year Treasury, tied to the global economy.
Yes.
We're going to see interest rates really jump up much higher than that at any point in the future, certainly in the foreseeable future. So rates are going to go up. That's okay. They are still remarkably cheap from a historic perspective.
Got it. So, Mathew, there's a lot being said about the lack of home sale. Why is this, and what do you see changing?
As we just were talking about, I think we're going to see slightly increased amount of inventory in the marketplace. I think new construction will help a lot. We'll start to see a lot more starts. We can see the baby boomers who are going to start deciding they need to downsize. That's going to help. But we are still going to see some very tight markets. Unfortunately, the Pacific Northwest and Seattle is one of them.
Got it.
So I think that we'll probably see a slight increase in transactions, but we're still going to have inventory levels which are already at double-decade lows.
Yes.
Really not getting that much better next year.
So, Mathew, when you're talking about the appreciation maybe being 4.7, 4.8% for 2016, so slowing down a little bit, which is not bad, but do you feel that that we're at risk of having a bubble coming up? What are your thoughts there?
The bubble question, it's always coming up, and it's come up a lot right now.
Yes.
No, we're not. And I think when you look at it from the national standpoint, obviously when the housing bubble burst, it was a national bursting of a market which had just got silly. We're not in that situation right now. And why I don't worry about it is really very simple. The mortgage instruments that we saw back in 2003, 4, 5, which were really kind of the negative amortization option arms, these ridiculous things that were out there, they don't exist anymore.
Yep.
And that makes me very, very happy.
And you have to be qualified to get a mortgage.
And that's the big thing. Now you actually, believe it or not, you've got to have a job to get a mortgage.
Yes.
You didn't necessarily have to do that before on the no documentation loans and the like. So that means that we have got the ability to service that debt.
Okay.
And therefore the likelihood of seeing a massive meltdown in the mortgage markets in their entirety, very, very unlikely. That said, I think there are certain markets in the US which are getting a little bit ahead of themselves.
Okay, and which markets would those be? What markets are you concerned about? I'm
specifically looking at Denver, Dallas, San Francisco, and actually New York as ones which are growing in price at a very heady rate, and they're becoming increasingly unaffordable. And so I think that those are markets which, although will not necessarily collapse, will start seeing a slowdown greater than that we're seeing across the country as a whole. Okay. So they are getting a bit ahead of themselves, but again, not set up for a collapse. So what are they, they always say that we follow like the San Francisco market. So does that mean if it does hit, they see a bubble, that it's going to follow and not we're necessarily seeing it next? No, I mean, we are similar to them in some respects. However, our housing values are approximately 50%. Of that you see in the Bay Area. Yeah, that's crazy. Yes. So we have a kind of median sales price about $500,000, let's say, in King County. Okay. In San Francisco, it's just over $1 million. Yeah. So it's a big discrepancy, and that's when you start having issues with affordability. Okay. I'm certainly not saying that King County locally is remarkably affordable. It's not. Yes. It is certainly very expensive, specifically for the first-time buyer. However, we're certainly not up in that 7-digit range that we're seeing down in Northern California. Makes sense. So millennials, they haven't been buying. Do you see that changing? The millennials, I think we will. It's so funny. The last year, I think we've been blaming the millennials for everything, from global warming on down to the collapse of the housing market. No, are they going to come back? I think they will, and here's why. that generation, basically born between 1980 and 2000, the older part of that generation are turning 30. So they are getting older. Now, they are starting their families later on in life, which is true, by about 1 or 2 years. So they're getting married later, having kids later, but they are looking to move out of those very expensive apartments, let's say in South Lake Union, and taking advantages of home ownership, as you talked about a bit earlier on, and creating families themselves. Now, when you look to do that, several things you're looking at, one of which is safety. Security is certainly very important. Schooling is remarkably important. You're not going to see these families raise their children in apartments.
Yes.
They are going to move out. So do they want to buy? Yes, they do. However, they've got a lot of obstacles ahead of them. Biggest one right now is student debt. They owe an awful lot of money on student loans. Look at student loans across the U.S., just federal student loans. It's about $1.3 trillion we owe on student loans that I anticipate in 20 years will actually get to $2.5 trillion. Now, some perspective on that, we owe about $890 billion on our credit cards. So we owe a third more on our student loans than we owe on our credit cards.
That's crazy.
And so it's a remarkable amount of money. And so it's hard for them. They're qualifying. It's still remarkably hard to qualify. We've seen FICO scores on approved loans. The average FICO score on a denied loan, for a denied conventional loan last month, was 700. Very, very high. So we kind of went from the sublime to the ridiculous on the pendulum of 1 point, everyone qualifying. Secondly, no one qualifying. So it's getting them to that credit rating, that credit quality, and also obviously down payments. That's hard for them as well. But when we see the mortgage, mortgage deductions are certainly remarkably important. Mortgage insurance premiums coming down. That's, again, very important as well.
And do you see some of it as just the education? Because you talk about down payment. I mean, there's so many different options out there. I think just people getting educated and understanding what's available are not missing out on the opportunity if they think they can't do it.
That's very true. I think, and certainly a lot of people that I speak to who are thinking about buying for the first time, they really are very uncertain as to how the process works. And much as I think there's a survey done fairly recently that says 75% of millennials wanted to buy, thought it would be the most astute financial investment they will ever make. But about 76% said they doubted they could qualify for a mortgage.
And I bet out of that 76% that probably maybe 25% couldn't. Just a guess. I don't know. But I hear so many people that come to me and that, well, I thought I needed 20% down, or, so that's a whole nother conversation there with you, Mathew. But I got to ask you, what keeps you up at night?
Several things. I think the
biggest, now I'm worried.
the biggest thing I think is us forgetting our past. Us getting back into the same issues that got us into the bursting the housing bubble in the first place. Repealing Dodd-Frank, for example, would be a horrible thing to have happen, because these are some of the controls which have been put in place that allow the mortgage markets to run efficiently, but also logically and sensibly. So I think those are the two biggest things that are out there. Credit control as well, as I mentioned earlier on. I think it's important, but we kind of got a bit ahead of ourselves in terms of how high the credit quality needed to be to get a mortgage. That needs to come down and still be at a logical level. You've still got to be able to afford to service that debt given your income. But right now it's still remarkably difficult. So that needs to come down a bit. If it doesn't, that's going to be a problem. But I think in all, we just need to make sure that banks are still the oversight is still there. And that we are still saying, no, don't get back into the days we saw 10 years ago of ridiculous mortgage lending.
Makes total sense.
And silly mortgage lending instruments.
I got less than 60 seconds to go to commercial, but I got to give a shout out for Windermere in having you as part of the team and a chief economist. That is not usual for a real estate company to have a position like you. What put Windermere in that they made that decision to bring on that position?
Well, thank you. Yeah, it's we are the only traditional brokerage that actually has an economist in-house. I've had a relationship with Windermere since the late 1990s as a consultant. And I remember back in, I think it was 2010, the president of Windermere and I were talking about how could we have seen this better, i.e. the bursting the housing bubble. And we talked. He said, well, perhaps you should do more for us. It took us about 5 years to get that right, but we did eventually. But I think what's important, certainly that ownership of Windermere see is we have about 6,500 agents. They need the information, they need the direction, they need to be able to advise their clients. And whether the market's going up or even if the market's going down, We're not going to tell them what they want to hear. I'll tell them what it's going to be.
Of course.
And I think that's just another tool we can offer our brokers across the 10 states where we're active.
Yeah.
And so I think it's a very it's an astute move, I think a very sensible move, and one certainly that so far the agents have been very, very happy with. And so I'm enjoying talking to as many as I can.
Yeah, that's
and
great.
answering their questions.
Well, I know they appreciate having you, definitely. Mathew, thank you so much for spending your time in here with me. I know that you're crazy busy and lots of conversations that you're having right now, so I appreciate your time.
You're very welcome. Thanks.
And coming up next in the Money Hour, today's real estate market for buyers and sellers, I have Tyler Freed with Windermere Real Estate right here at 1150 AM KKNW after this short break.